So in this video, what I wanted to focus on was the difference between correlation and co-integration. And this is really, really important for co-integration arbitrage traders. It's really, really important for pairs trading. In general, it's very important if you want to have a coin that serves as a base that gives you certainty that the behavior of another coin doesn't really make sense. So there's a lot of ways you can use this as frankly, one of the best indicators out there. So the first thing I'm looking at here is correlation. I'm looking at Bitcoin to the dollar versus Ethereum to the dollar. Now, the price pattern, the price movement, I think you would agree, is very well correlated. I don't need to calculate it. Like, I can see it. It's really, really well correlated. Now, if we calculate the difference in the spread of the prices, you'll see that the spread gets wider. So the difference in prices gets wider. If I was to plot that on a chart, it would look like this. We would just notice the spread going up. Now this poses a problem for pairs trading because normally what would happen is if say one coin moved up and the other one didn't really change, what you would do is you would short the one coin and go long on the other coin. And you would trade based on the idea that the difference in those prices would come back to their average. And that is really clearly not really happening here. So that presents a problem because you're not sure, well, how much of my capital do I put on this coin? How much on that? How much should I go long on? How much should I go short on? And what is my risk? Because my risk is actually quite high. One coin can still move quite far from the other. And that's evident just by looking at this chart. Bitcoin has moved 180%, Ethereum 45%. So that presents an issue. So what we're looking for is a co-integrated pair. So right now, for example, I'm looking at Litecoin to Bitcoin and Ethereum to Bitcoin on BitMax. And right now, in terms of 30-minute bars, these two coins are very well co-integrated. Now, what do I mean by co-integration? Well, I think looking at these two price charts, you would agree with me that these two prices are moving with each other. It's almost like there's an elastic band that is pulling them together. So if one is shooting up, it's pulling the other one up or vice versa. It's almost like there's an elastic band, an invisible elastic band, that if they diverge too much, they're coming back together. So the difference between co-integration and correlation is co-integration measures how well and how strongly is that pair of coins actually tied to the other. Now, this can present a lot of opportunities, and there's a way to measure the difference of these two coins using something called the Z-score. So what's really cool about this is if this was a coin that you could trade, it's pretty obvious where you would buy and where you would sell. And this presents a really great arbitrage opportunity because there's plenty of volume that can be traded. Unlike right now, what we're seeing typically on Fridays as well is there's very few arbitrage opportunities. By the way, just heads up, I've noticed on Sundays, there seem to be a lot more, just letting you know. But we've noticed that that is becoming quite tricky because the market becomes saturated with arbitrage. Once people know that there's certain opportunities in certain areas, they get eaten up. But there's plenty of volume here, and co-integrated pairs are changing all the time. One of the other things you can do is look at the volume as well. So if there is a spike on one coin and the other one isn't following, very much like what happened here. So we can see this spike happened early on, and it took later for that spike to happen here. You can make money on that. You can figure out based on the volume and the number of trades whether that spike is genuine, i.e. whether it's a pump. And very often if you're looking at rubbish coins versus good coins, here we're looking at Litecoin versus Ethereum to Bitcoin, right? So these are two very good coins. But if you're looking at rubbish coins, then you can see whether there's a pump going on, etc. And if you have a margin account like on Poloniex or BitMax, etc., you can short that, make sure you put a stop loss in. Or vice versa, if you know there's a leading coin that is moving up, there's volume that's come in and the other coin's yet to catch up, you could place a small little stop loss there and just go long. So even if you don't like shorting and you don't want to pairs trade, you have another base, you have another indicator that acts as an elastic band. It gives you so much context. It's almost like having a crystal ball, which is super, super cool. And it's something that honestly, I've spent the last year and a half working out how to track in my head. And the last 8 weeks really crunching into the coding, etc., to calculate these pairs, etc. So in up and coming videos, I'm going to show you the Z-score. I'm going to show you how to calculate this stuff yourself. Co-integration is fairly tricky. It does require tools for Excel, but Z-score is something that's very, very straightforward. And I'm learning in all sorts of analysis I've been doing underground while I've been going sort of inside. I've been seeing all sorts of opportunities there with Z-score too. So I'm looking forward to the value that you guys are going to get from those up and coming videos. If you've got any questions, punch them in the comments, and I look forward to seeing you in the next one.